All right, let's jump right into a real head-scratcher for investors. You've got two powerhouse insurance companies, Kinsale Capital and Progressive. Both are absolutely crushing it in their own way, but their stocks, they're telling two completely different tales.
So in one corner, you've got Kinsale Capital. They're the niche specialist. We're talking a $9 billion market cap, which sounds big, but wait till you see the other guy. But here's the kicker, a stunning 30% return on equity. And in the other corner, the absolute behemoth, Progressive, a market cap over $126 billion. And get this, they're still growing policies at an incredible 12% clip.
So what gives? We have this incredible, elite profitability on one side versus massive, unstoppable growth on the other. But the market seems to be cheering for Progressive's growth and giving Kinsale's future the side-eye. So today, we're going to dig in and figure out why. We'll look at their playbooks, their numbers, and what the market is really thinking.
Okay, so first things first. Let's get down to brass tacks. How are these companies actually making their money?
Kinsale's whole game is playing in a special sandbox called the excess and surplus market. Basically, they insure the weird, hard-to-place risks that regular insurance companies won't even touch. And their secret weapon? Some killer proprietary tech that gives them a massive 8-point cost advantage. Progressive, on the other hand, they're all about volume, pure and simple. They are the kings of auto insurance, using this awesome two-pronged attack of selling directly and through agents, and they're the pioneers in using driving data to set prices.
Now, if you want to know who's really good at the core business of insurance, there's one number you gotta know, the combined ratio. It's the ultimate report card. Think of it like this. For every dollar an insurer collects, the combined ratio tells you how many cents they pay out in claims and costs. So anything under 100% is a profit. The lower that number, the better they are.
And bam, just look at this. This is where you really see Kinsale's magic. A combined ratio of just under 75%. That means for every dollar they bring in, they're paying out less than 75 cents. That is incredible. Now, Progressive is no slouch. They're very profitable at 89.5%. But wow, Kinsale is just playing a different game when it comes to pure profit-making discipline.
Okay, so Kinsale is the undisputed champ of profitability. Game over, right? Well, not so fast, because there's a whole other side to this puzzle, and that is growth.
And here's where the plot thickens. Kinsale's profit machine is humming along beautifully, but its growth engine, it's starting to sputter. Meanwhile, Progressive, this massive giant, is somehow still gobbling up customers like there's no tomorrow.
You have to understand, investors were hooked on this. For years, Kinsale was an absolute rocket ship, posting these jaw-dropping growth rates of over 40%.
And then this, 8.4%. Now don't get me wrong, growth is growth. But when you go from 40+% down to single digits, for a stock that's priced for perfection, that's not just a slowdown, it's a screeching halt in the eyes of the market.
And while Kinsale is hitting the brakes, look at Progressive. The scale is just mind-boggling. We're talking 4.2 million new customers in a single year. That's the sheer power you get from being a household name with a massive machine behind you.
So this is the heart of the dilemma, right? It's all about what the company is doing versus what the market thinks it's going to do in the future.
Which brings us back to that crazy puzzle. Kinsale comes out, posts amazing earnings, crushes expectations, shows off that world-class profitability, and what happens? The stock tanks. It drops almost 7%. What on earth is going on? Well, it's like there are two different Kinsales, depending on who you ask. The bulls are looking at the here and now. They see those elite numbers, that incredible combined ratio and ROE, and that tech advantage. But the bears? They're looking ahead. They see that growth slamming on the brakes, a pretty high valuation, and the fact that 7 different analysts have lowered their expectations for the future.
And you can see this split right here in the analyst ratings. You've got your believers, like Morgan Stanley and Truist, who are still saying buy. But then you have the skeptics, RBC and BMO, who are on the sidelines with a hold. They're looking at that high price tag and saying, wait a minute, if the hypergrowth is over, is it really worth this much anymore?
And hey, don't just take my word for it. Listen to what Kinsale's own management is saying. They're basically telling everyone on their earnings call, look, it's getting crowded in here. All these new competitors are jumping into their special niche, and that's putting a real squeeze on prices and, you guessed it, growth.
All right, let's flip the coin and look at Progressive. The bull story is pretty straightforward, right? They're growing like a weed, they're a market leader, and the stock's valuation actually looks pretty attractive.
But the bears are waving a big caution flag. They're worried about the entire auto insurance industry hitting a rough patch, intense competition, and nasty surprises like a $950 million regulatory charge out of Florida.
And man, if you thought the analysts were divided on Kinsale, look at this. They are all over the map on Progressive. You've got big names like Barclays and Bank of America saying buy, but then Morgan Stanley is out there slapping a sell rating on it. That tells you just how much uncertainty there is about the future.
This quote right here from William Blair is huge. When they downgraded Progressive, they made it really clear. This isn't just a Progressive problem. They are ringing the alarm bell for the entire auto insurance sector. They're expecting costs to go up for everyone in the near future.
Okay, so with all that on the table, what's the game plan? Where do these two giants go from here?
For Kinsale, it's all about finding new playgrounds. They're trying to take that tech advantage into new areas like transportation and farming to try and get that growth engine started again. Progressive strategy is all about going deeper with the customers they have. They're chasing what they call the Robinsons, households with multiple insurance policies, a market worth a whopping $230 billion.
So, what's the big takeaway from all this? It's that a stock's price is a story. It's a mix of how the company is doing right now, what the market thinks it's going to do tomorrow, and all the expectations that are already baked into the price. A fantastic company isn't always a fantastic stock, especially if everyone already knows its growth story.
And that really leaves us with the big question for you to think about. When you're looking at an investment, what do you value more? The company that is performing perfectly today, like Kinsale, or the one with the massive ongoing growth story for tomorrow, like Progressive? Because how you answer that, well, that says a lot about the kind of investor you are.